this is really an assessment of risk for the business owner. We believe our minority equity buyout allows a business owner to mitigate a lot of their risk, but still preserve a lot of their upside from their post-closing ownership percentage as majority business owner. However, there are other options. The first option is a mezzanine debt recap. In this situation, a business owner can get a similar size liquidity event from a mezzanine debt fund by taking on a lot of debt. They still own 100% of the business, but post-closing, the business has a large amount of debt on its balance sheet that has to be repaid. While the business owner does retain 100% ownership of the business, again, the business itself is indebted, and this debt carries typically between a 12% and an 18% interest rate, which is really quite high. While the good news to the business owner is this type debt is non-recourse, meaning they don't have to personally guarantee the debt. It's the company's debt, not their debt personally. The bad news is these loans are typically 5 years in length. The term of the loan is 5 years. So at the end of the 5 years, if the business cannot repay the entire amount that the business borrowed, the mezzanine debt firm would end up owning the entire assets, owning 100% of the equity of the business. And so for a business owner that is really worried about the worst case scenario, preserving their net worth and diversifying some of their risk, this type transaction can really do just the opposite if earnings of the business subsequently decline. The next alternative would be a business owner going to a bank to do a debt recap as well. This type debt is a lower cost of capital than mezzanine debt, perhaps 5% interest rate. But when a business owner is looking to take out a large amount of capital from their business, the reason a bank would give them a lower interest rate than a mezzanine debt firm is that that debt is ultimately going to be secured by, first and foremost, the assets of the company, and then secondarily from the business owner himself or herself. So while the good thing about the mezzanine debt is it is just at the company level, in this situation, if the company defaults or cannot repay the debt to the bank is going to come after the business owner personally. And so you could have a situation if earnings subsequently deteriorate after doing this deal where both the company and the owner personally file bankruptcy. Again, we believe our minority equity buyout approach works well for business owners that are quite debt averse. They're very conservative. They know really by doing this transaction that they're not risking any of their personal assets, and they're taking some chips off the table and really having different risk profiles for capital instead of layering on multiple layers of risk.